If we can just start it from a holistic approach, looking at the property market, what does your most recent data tell you about the health of it?
Well, the market was already well and truly heading into a downturn before the budget. Several rate hikes, affordability challenges, serviceability issues, confidence was very low. So it's hard to dissect what's a direct implication from the budget and what was already happening. And I think that'll be the challenge going forward. But to be fair, Sydney did see a very low clearance rate over the weekend. It was down at 49%. Melbourne, in fact, just saw a subtle rise in the clearance rates, rising up to the very low 60% range. So I think this reflects maybe the fact that we are seeing a lot more investors in the Sydney market than Melbourne, and probably some pullback early, based on what we saw in the budget announcements, whereas Melbourne is very much more aligned with first home buyer activity. It's not quite as unaffordable as Sydney either. So maybe we're starting to see some early outcomes here, but absolutely, it's early days.
Yeah, early days indeed. But given that you've been in the market for such a long time and a commentator on it, how important is sentiment when it comes to the property market?
Sentiment's critical. We're talking about very high commitment financial decisions here. So when we see confidence low, we generally see a pullback in purchasing activity, which makes sense. I mean, when you're talking about hundreds of thousands of dollars, if not millions, to buy a home, absolutely, there's going to be a pullback. And we are expecting to see a sharp pullback in investment activity, as well as just a more broad-based slowdown in housing demands from factors we're already seeing prior to the budget announcement.
You mentioned those Sydney and Melbourne auction clearance rates working against one another. How did the other capital city states fare?
Well, the other capitals were a pretty mixed bag. You've got to remember, auction markets are very centric to Sydney and Melbourne. Once you get into some of the smaller capitals, Brisbane, Adelaide, you only see about 15% of homes taken to auction. In Perth, it's only about 2% of properties are auctioned. So you get a much better feel for the market from things like how long properties stay on the market, so time on market or discounting rates. But each of those markets did see different directions. So again, I think it's hard to really pull any meaningful insights out of the early auction data for those smaller capital cities.
If you look historically at the different capital cities and different periods of downturn, how long do they last for?
Well, the most recent downturn was in the middle of 2022, just as interest rates started to rise, and it went through to late 2023. So even with interest rates still rising, we saw housing markets move through the bottom of the cycle, and once again, values start to rise on the back of extremely low supply levels and strong rates of demand. Go back prior to that, it was after the global financial crisis, we saw a slump, or even before that, it was 2017 to 2019, and it was about a 24-month downturn. So downturns can be the result of really, there's a lot of catalysts. It could be rising interest rates, it could be a shock, it could be tighter financial or credit availability, like what we saw through the Royal Commission. I think this time around, it's very much due to a combination of affordability challenges, rising interest rates, and heavily indebted household sector that's probably going to be a lot more sensitive to rate hikes, and that then add to that the pullback in investor activity.
Yeah, I was going to ask you about that, the loan issues and how many people might have buffers and might not, given that when you look at Sydney in particular, they're coming off a very strong base of increases after increases over the last couple of decades. How much buffer do these people have?
Well, the buffers are generally very healthy. Remember, we're in a very strong prudential system here in Australia. So even with interest rates rising, any borrower would have been assessed to repay their debt 3 percentage points higher than the going rate at the time. And as you say, Kath, there's been a significant level of growth in the housing market nationally. Just over the past 5 years, housing values are up nearly 40%. In some markets, like Perth, they're up about 90%. But there are other examples, like Melbourne is only seen a little bit less than 6% growth in 5 years. So there will be some homeowners that are probably more exposed to the risk of negative equity Add to that, I guess, the risk of first home buyers that would have taken the advantage of a 5% deposit guarantee. It doesn't take much for that type of buyer to move into a negative equity situation, given their recency to the market and the very small deposit.
Tim Lawless, always good to speak with you. Thank you.
Thanks, Kath.